Good afternoon, everyone. Hope everyone's good. Is it audible? Good afternoon. Nice. So guys, quickly, I think now. So I had told you to make the model of hero. Did anyone try doing it? Did your balance sheet match? Tallied? With these numbers? Great, I think okay. Balance sheet is tallying. So what you can do is just try changing any numbers over here, your assumptions. The balance sheet should change. Huh? Okay, fine. So yeah, FCFF. So we were up to here, no FCFF. We were over here. FC. This was for FY22. Let me drag this. Okay, 26. Okay, 1, 2, 3, 4. Okay. Now, yesterday I've told, last day I've told you that that we will see how this number. So 22 has already been there. Already been the annual report is already out. Now over here, if you see, this is the format of a company which is there in the annual report. So nowadays, this format is constant across the company. Every year you will find the same format. Same way for balance sheet. No, it is same format I have copy pasted. I will show you. Then let me open the annual report of company. Now this annual report is of Hero, and we have to take the consolidated number. I hope you know where to get annual reports. You can just Google it, or now you can go on the BSE website. Just Google annual report for Hero, you will find it. Okay, now over here, an annual report, okay, financial statements. And then we have to go for consolidated one. This is standalone. Let's go to console. This is one of the important things that you need to know, because on job you don't get numbers directly. This copy pasting is also a task. And make sure whenever you open this, it should be in your Adobe Acrobat reader. If you open it in normal Google Sheet, it will not help you to copy and paste. Now what I've done over here, see the balance sheet. I have just copied the numbers as it is. This all things. Okay, let me start from your P&L. This is your profit and loss. So what you can do is over here. Now this, if you copy like this, it will never work. See, copy, and if I paste this, it comes like this. You cannot do that. If you have advanced Excel and advanced, this is all paid. When you have all paid Excel and paid your PDF, that time only you can convert from PDF to Excel. Normally, which is unpaid version, you cannot do it. Now, how to do it? Okay, now let me tell you how to do it. Okay, this is one I have made. I will show you one how to make it. Over here, remember you have to copy it by, you have to press Alt. Whenever you press Alt, you see the cursor has changed. You see, this cursor has changed. Leave Alt. I am pressing Alt. Whenever I press Alt, you get a rectangle cursor. Now you have to keep that Alt press and then just drag it as you copy. Again, this is column wise. You have to copy column by column. So this is column. This is column. Okay, these are all columns and this is rows. So don't copy both the columns at once. It will not, it will not come. Do this, it will not come. It will again come like this. What you have to do is you have to just copy the column. So press Alt, keep the Alt press, and then just drag it. And here we are only interested in net profit after tax. Okay, over here. Net profit after tax. What I do is I copy. Now see, Control C. You can also do right click and copy. Go to Excel and just paste it. No, it comes directly. Okay. Now one more thing that you have to keep in mind is that whenever you copy, the Excel doesn't consider the spaces. This is a space between share and loss and profit. There was a space, but here the Excel doesn't consider the space. So while copying numbers, whenever you copy, make sure you only copy till there's no space. Only copy the number. If there's a space, just stop it over here. But if you copy like this, see, if you copy the same thing like this, you will not get the numbers. Which is numbers, it should end at over here, right? Net profit, but it is ending over here in deferred taxes. So this doesn't take the spaces. So make sure you, whenever you copy, make sure you copy this. Okay, this one, same, press Alt and then select it. Copy, paste this. Again, copy. Now there's no space over here. So you can just copy and paste till end. So now it starts from cost of material. Okay, it starts from cost of material. So make sure it starts from cost of material. Okay. So now this amount, total expenses, is a combination of all, right? So make sure that it should be a sum of all. Take a sum of all. Number should tally. Now this profit before income tax, so can I say this also? Again, this also is, can I say this plus this? Whatever, whenever you copy paste, make sure that numbers are, this bold number should be calculated in your Excel. Though it is, you can copy paste it also, but for forecasting, it is better you do this way. All the numbers which are calculated, make sure you calculate on Excel as well. Now this profit before tax should be what? Your total income minus your total expenses. Now it should tally. See, it will tally. Now this again, share in profit and losses. This is your share on loss and profit. Now there are two things: loss from associate, and from this is one heading. This is a heading, okay, and from here it is this amount is over here. Okay. And then the profit before tax is what? This plus this. Okay. Make sure it should 3058. Same thing now, deferred tax assets. Now make sure deferred tax asset is over here. And then club this. All the numbers you need to club 729. Now over here it is this minus this. See, the numbers should tally. Tally? Got it, guys? Got it? Easy? Now it doesn't take time. It only takes time for the first time. Now, after doing this, you can just copy paste things. Let me show you now. I have done this for FY21. Okay, like this. You see, it is same to same. 39. This answer 35.9. So this I have already done it. Now what I have to do is over here. See, these are all. This all it is coming from all the bold amount. I know it is coming from from some calculation. So what I will do is I'll just copy this. First I will paste it over here. Then I know that I only need to change this numbers. What are numbers? Let's see how quickly it is. I have to just change this. Okay. It is changing all. Then this copy. Okay. Now here you see, now it was different over here. Till FY21, 20 there was excise duty. Now it is excise duty is not there. So make sure these are only three things are there. Copy and then paste. Now again this now it starts from employee benefits. And employee benefits start from over here. It's over. There. Okay, 19. We all done. You should see this 26 is matching. 3527 is also matching. Then loss in share of profit is this. Okay, minus. There was nothing over here because your deferred tax. It took me hardly 2 minutes to do it. Okay, to tally 329 is tallying. Okay, and for here, just keep your number of shares ready because your basic EPS is this. Face value is 2. Guys, your basic EPS is your face value is 2. Okay. The equity share capital. Can you get an equity share capital? Where do you get your equity share capital? Where do you get your equity share capital? Nice. Where you get your equity share capital? In the balance sheet, right? So in the balance sheet, I have an equity share capital over here, which is 39.6. Okay. 39.6 is my share capital. My face value is 2. So what will be the number of shares? What will be my number of shares? My equity share capital is 2. It should be what? This 39 to divided by this 2. Okay, so you can now calculate your basic EPS. Now this is the profit which is available to the shareholder. You can calculate your own basic. Now it will change because here the profit is they don't take this profit is taken. They will take this profit contributed to the owners. You don't require it. It is okay to take this. Okay. They have given 15.96. This is your 15.96. This is number of shares. So 15.96 into if I do number of shares, they have taken 2316 of profit. So it was this one profit. Okay. So this is fine. This you don't have to do this. It's okay. So this is how you find number of shares from your P&L. Now see over here in the P&L, since I have linked everything. See what is this? This net sales has been linked from over here. Okay, this one FY22. Same, all the expenses are linked. Again, the raw material consumed, you see, it is linked from over here. Now, what I have to do is, when the results are out, I just need to copy this. Just copy this to the end and just Control R. You see, you got the number 2329. Got the number 2329. This is what I have made a format. So see, automatically I got what is the growth over here. You see, my revenue has declined. What is it? 29, my revenue declined. Yeah, my revenue has declined. 21 became 20. So here I automatically from here this figure you don't get any information. But when I do this, put it into a format, I get the numbers as it is. My net sales have declined. My cost of sales have increased. No, this is not assumption. No, this is actual. The cost of sales have increased. This my gross profit has declined. Employee expenses have increased by 2%. Other expenses are 10.8%. All I got with just one click. It was just you need to do it once at least. In this format, whatever see till EBIT you can do it. After this, or the other income. After that, you can just take all the exceptional items and put it. Now, here is no exceptional item. Over here, this was only one exceptional item. Loss and profit. Here, though, it was all till EBIT. You can find employee expenses. What are the expenses? Employee and other expenses. Here it comes EBITDA. Then after that, you minus your depreciation. It's come your EBIT. And after that, EBIT, you minus your finance cost. Then you come with your earnings before taxes. Earnings before taxes. Then other income is added. And then your taxes. So I have made this. You can have a look at this. How I have done it. You try to do it for some other company and see your profit should match. This profit should be equal. This is coming from a calculation. This profit should match your number. Okay, over here 2329. 1, 2, 3, 4. Okay, now let us do it for 50th. Now same way for balance sheet. Now I have done it for 1 year. You have to do it for 22. Now 22 is there. Now see, the numbers are usually same. First 5 will be same. Just copy and over here just paste. Then again this also. I think it should match. Yeah. 42. Okay, what is this? 42. Here total non-current asset is matching or not? 1106. It is matching. Okay. 110617. Then your inventories. Whenever there's a space, just don't copy that. Okay. Don't copy the space. Copy only till there's no space. Just copy. See, it doesn't take me time to do because this is already linked. Okay. Again over here. So these are the things now which is required in your on job because this is what you are expected to do. Everything you will not get, as it is. Copy pasting is also a task, also a skill that you need to do. How fast, how quickly you do. You cannot start punching numbers. Okay, it will take a lot of time for you to punch numbers. So what I'm doing, I'm just changing numbers. You try to do it with one of your models. Now see, trade payables, I have linked everything. Okay, over here. You also make sure you link this 26.19 plus 4316.9. This is total of this two. Okay. The trade payables, there's a total of this two. Okay. Then so carefully do it. Once you do it, all tally. Now see, balance sheet is tallying. Tallying. Same way you can do it for cash flows as well. I will not do it for cash flows because cash flow will take time. Okay. What are we interested over here? We are just interested in getting the closing cash from the balance sheet. My balance sheet will tally on its own. This is my new closing cash. Okay, 181. My balance sheet will tally on its own. Other equity. We'll see, we are again interested in this other equity. This will all change. Okay. Balance sheet is tallying. Guys, again now help me to tally my balance sheet is not tallying. Can you help me? Okay, asset. Okay, this so now this one. Okay, asset schedule is remaining. Now, how you get this asset schedule? How did I get this? This number 534 and this one, it should come from a schedule, right? And I have seen that there's a number which is over here 551. Now, how did I get this? If you see carefully in your, you see the numbers are given over here. How this number is arrived, there is a schedule which is being made. Let's go to, it says note 5, plant property. We are interested in knowing this schedule. Plant property and equipment. Let's go over here. Plant property, note 5. Go down 5. You see over here, the format is little bit different. April 2020 at April. So it is what? This is which at March 21. So can I say this is the closing? This is the closing amount. Let me know. Let me do this. Now I have a balance sheet of what? 21 and 22. Right? This is balance sheet that I have. Cost at April 1, 2020. What is March opening or closing? At March 31. 31201. It should be closing amount or opening amount. Opening amount for what? Which year? will be opening as of March. Na? Balance sheet is made as of March, right? 2021. So this is closing figure for 2021. And you see there's a cost over, these are two schedules. There's a cost over here, you see a cost, and there is accumulated depreciation. And the same thing that we did. Here we made the gross block, that is your cost model. Okay, it's the cost of the assets that you have purchased and your depreciation, that is the accumulation. Then you come with net fixed asset. There was a reason I made this, and I told you to do this. No one teaches this in financial model, and when you go on job now, there's a problem that how to get this asset schedule. See now over here, you will find exactly what cost the company has purchased the asset and what is the total accumulated depreciation. You see, cost at April 2020 means obviously it is the opening of 21. This is 9771. So see, there are many assets over here. You see, free-owned land, buildings, land and equipment, machineries, vehicles. Now, you don't have to forecast for every asset. You can directly take the total. Every asset is, if required by a manager, then only do it. But ideally, when you're doing your own model, make sure you take the total one, because ideally everyone knows capex is a capex. Okay. See over here 9771. It will be your opening of 2021. 9771 is your opening of 2021. Opening. Then addition. Addition is your capex. How much? 371 was the capex. Sold. The disposal is your sold. Okay, 3007. Now other things are there. You can just put it others. Okay, whatever things are there, you can just make an item and say others. This is 1.9. This is foreign currency again, which we cannot forecast it. We just keep it over here. Okay. Now closing. Now see this closing. So now what is it? Opening plus addition minus sold, and this just add as it is. The number, what is it? Add as it is. It should tally 10, 6, 6, 7. We can't forecast sold. Now, yeah, forecast sold is not there. We cannot forecast sold. We have to only think about the capex that company is doing. Okay. Now this closing, can I say this closing will become opening? Right, we have done this. This closing becomes opening. Now, again, this closing becomes opening. This is addition for next year. 424. See over here. Then disposals. And then add as it is, whatever the number is. So this item gives you the actual capex amount. Now see 10, 3, 4, 7, 7 matches. This two number matches, right? Now we come to our accumulated depreciation. See again, as at April 2020. So it is the opening of, this should be the opening of 2021. This over here. Opening, then depreciation for the year. So there are items over here which needs to be now others. Just put all the items as others. No, sorry, this is a disposal for depreciation and then others. Okay. You don't have to focus this, you just have to put it. What is disposals? 89. And foreign currency translation as it is, keep it as it is. These are things you don't need to focus. Now, accumulation will be what? Opening plus depreciation minus sold, and then this whatever the amount is. 4516. This closing will become opening for next year. Then again depreciation for next year. 6003. 1281 is your disposal. And then this is your 107. And then just copy this. 4993, 499. This should tally, okay, means you have done this properly. Now your net fixed asset is what? Closing minus, sorry, this closing minus accumulated depreciation. See, it should tally 550. It's tallying with your balance sheet. 55067. Same way over here, it should tally over here 5345. This is the amount 5345. And here you actually found your capex. Now, when you do it for more years, you will find the actual capex that company. This is the capex that company does. Now, how will you find depreciation over here? Depreciation rate rather. This is the depreciation that is being charged for the year, and your total assets are this gross assets. The depreciation for the year is around 6%. Same way over here is also around 6%. So you get an approx average that your depreciation is approx 6%. And this is for 2 years. Let me do it for 1 more year. The average of historical. So this numbers we get it, historical numbers. So we'll get approx how much is the capex that the company is doing. That is why 5 years balance sheet is necessary. Let me do it. I have one more balance sheet which is of 2021. Okay. I have for 2021. Let me show you for 1 more year. Consolidated balance sheet. This is for 2020. This is this 2120. The 21 we already have. We have to find this 786 number. Is there in our balance sheet? Number is there, right? 5786. Let me show you how you get it. This is again note 5. So note 5. Note 5. Over here. Okay, now April 1 means what? Okay, April 2019 will be opening for March 2020. We are finding what March 2020, right? Over here. This is the opening of March 2020. Then addition, disposals, and these are 2 things which are in others. Is what? This is less. See, they have written less. So make sure you put a equal to a negative sign, and just write 123.23 equal to 123.23 plus that 141. See, the amount is telling. This closing will be opening, right? It is. It should tally. Your balance sheet will tally these numbers. Again, this accumulation. Addition. This is what we had. Okay, last year we had done this. Now again accumulation. We can just copy this number in here at least. Disposals, because we already know that this is the opening. The other part we can. It is again less. Make sure you put a negative sign. 14.90 plus it is again minus 0.37. How do you drag the formula leftward? No, I didn't drag it. I just copied and pasted. Just copy, paste it. Okay. Left you cannot do it. Right you can do it for Control R. Left you cannot do it. Just copy and enter. 786. Got it? Same amount. 7864, and then look at your depreciation rate was 6.7% in FY20. So you can take, when you do it for last 5 years, now you get an average around this. As of now, we have taken 6 is an average. Okay. What we do now, this will become opening for next year. Now, what is the capex? Let us say we have only 3 years. The average is around. See, now this is 860. So what we do is we don't write 860. We say around 900 crore is approx capex that company does. Okay. 900 crores is around capex. We don't say 860 is the capex, okay? Or we can say 850, okay? Always keep numbers, approx numbers. Don't write specific numbers. It should be always approx. Approx 850 crores is the capex that company does. Sold we don't assume. This also we don't assume. Closing. Yeah. Now it is because it was COVID year, no? That is why it is this. Now when you take it for 5 years, you will get an approx amount. This was COVID years, 21, where the capex was low because of COVID. You know, they had not done any capex. You do it for 2-3 years, you will get an approx average. Okay, so make sure now whenever you're doing new models, don't assume 21 and 22 numbers because 21, 22 was COVID related issues. Okay, so I have just taken it for your assumptions. Okay, as of now, but I don't have the numbers. I have to punch it. It will take time for me to punch. Okay, accumulation. Okay, over here. Again, this will become over here. Now, depreciation for the year, it will be what? This into the 6% over here. Now, this all things you don't need to assume. Right, is my voice breaking? Rita has a problem. Is it? Net fixed asset is this. What you do is just now copy and just paste it this way. You will get your. You can change the numbers. Okay. This becomes, if you get any assumptions for your historical numbers, you can do this. You can change your assumptions. This is I'm just giving a random assumption. Okay. This is how you do your. Now this numbers obviously will get reflected in your balance sheet in FY23. Okay, over here, some numbers will get reflected. Okay. Okay, other equity will come from. Now we'll start at 23 forecasting. Now this is all we have already done it. Okay. Working capital is what we have found. Okay. Debt schedule. Okay, we don't need to change. Our cash flows. This is what we required the last year. Okay. So now everything has changed over here. 850 and all has. Now I think it should tally. This should. This number changes. These are number changes. This already has changed. I'm not changing anything. Also here, this number should come from. Where should this number come from? 335 now. Make sure you do all the changes because this numbers will change now because these are all historical numbers now. Okay. We are not interested in knowing the opening. We are just interested in knowing the closing one. Okay. Interest will we get from your P&L account. Should we change the balance sheet numbers to forecast figure and keep the same historical? Yeah, historical number should be. You have to change now because this you have assumptions over here. Now make sure you just give the closing amount. Opening and closing. Opening is not required. Just change the closing amount. Or because now it should be linked from your balance sheet. In your schedules, all the closing amount of FY22 should be linked from your balance sheet. It's already been linked. So this again should be linked from your. All the numbers are now linked from here. This is historical, okay? 22 is historical. Now your cash flow should, your balance sheet should tally. Telling? Now what I'm doing, whatever things I have changed, I have just linked it again because my cash flow is already been linked. Right? Tally. What I've done over here is I have again linked all the numbers properly from my fixed because it was already linked over here. I've just copy pasted it over here. Yeah. My balance sheet tally. Now I have got a new numbers over here. Let us do it for one more year. We have started from 22. Now we'll do it from 23. Okay, we'll start from 23 only. Now what we do is asset schedule 27. Other equity also will do 27. Okay. Working capital. See again, just have to just copy Control R. Everything comes on its own. All schedules done first. First do your schedule, then do your cash flows, then come on to your balance sheet. It will tally. Okay. This is one of the most important things to do. If you don't know this, you will have, clearing interviews will be a very big task because they want you to know that how is the balance sheet being tallied. If you don't know to tally a balance sheet, valuation and all doesn't play a part. In DCF and all, everyone knows it is not a big thing. Tallying the balance sheet, it is what you know accounts and you know finance. And as I've told you, there's nothing about accounts and finance into it. It is purely common sense. If things are changing, what are the other things that are impacting? That is the only thing that we need to know. And it should be all linked to each other. Fine? Okay, I got the FCFF. Now why have we found all this? What is the reason? Now we'll come on to the valuation part. After tallying the balance sheet, we have spent approx 8 hours just tallying, 8 to 9 hours just tallying the balance sheet. Because valuation is not a big thing. It is everyone knows. Valuation. Tallying and forecasting is only the important thing. This copy pasting thing is also one of the part of your modeling. If you don't know how to copy paste historical numbers, this all numbers, how will you find the answers? Now this I have done only for PP. Okay, this was only for PP. You have to do it for your other assets as well. You get it. The right of use of asset also same. See, same format. And again, you have to do it again for your intangible assets. Because in the P&L, the depreciation says it is depreciation and amortization. Right? This expense is depreciation and amortization. So as of now, I have done only for one asset. How many assets are there? One, this, and this. You have to make schedule for all this in the same format how we did it over here. Okay. This helps you get your exact capex number and helps you to tally your balance sheet. Okay. Fine. To try doing this, take one dummy company. Next time if you have doubts, if you don't try, you will never have doubts. And believe me, this is the only thing which are asked in interviews. If you tell them, if you make 4 or 5 models of your own, then analyze it and tell it to the company that I have done this. Ratios, I think many of you must know how to calculate the ratios and all. So just focus this, come to a valuation, make 4 or 5 models of the same industry, you will find the difference. At least from the historical numbers, you will find what is changing, what is the capex that let's say what is the capex Hero is doing, what is the capex Bajaj is doing, what is the capex TVS is doing. How you figure out when the balance sheet will never have a figure. If you have done some mistakes, then only it will have a problem. Now I've told you what to do is I've written the steps over here. Just clone the balance sheet whenever you do. If FY22 is tallying, FY23 will tally. The first thing is you have to do this should be equal to this. And if you change any other number, see if I change any other number, there should be a difference over here. This is how it should be first made. Then you know that if this is changed, what will impact? Let us say I say that, okay, your investment, okay, 2545 became 3000. You see the difference? What is this difference now? How should you tally this difference? My investments have increased. So what has happened? Everything flows from cash flows. Any change in asset and any change in liabilities will impact your cash flows. So as I've told you, do one by one till you always change. We have done it in the last class. So make sure you look at the videos, you have the access. So I have tallied that. That is very important. These steps are very important. Yeah, no, as of now it is just investment. That will not, that depends if there is an adjustment given. Now I've just assumed that if the assets have changed, obviously it is assumed that you have purchased the cash, or purchased through cash. Link the balance sheet with cash flow ending balance. Try changing only one number. First change only one number and then try to change. Over here, trade receivables, since I have linked this, always change one item, and only how many items you have to change? 1, 2, 3, 4, 5, almost 6, 7 items only you have to change on a balance sheet. Any balance sheet, other numbers are not to be forecasted. You cannot forecast those numbers. It's very difficult to forecast it. Okay. Only few numbers are only which is related to sales we need to focus, because we are finding FCFF. In FCFS, what is required? PAT is required. It comes from P&L. So PAT also impacts your other equity. That is why other equity will change. Depreciation impacts your asset schedule. That is why asset schedule is to be changed. Interest on this is coming from a debt schedule. That is why debt needs to be changed. And then working capital. This comes from your inventories, receivables, and payables. And then capex, again this two comes from your debt schedule, sorry, asset schedule. That is why only few items on the balance sheet needs to be changed. Rest all we are not interested in that items. Keep it as it is. Even in the cash flows, this all items you don't need to forecast it. In the cash flow should be clean. It should be very clean. Hardly you will find numbers on the cash flows. It is just how you link it and tally it. How you link it, that is important. Plus, minus, addition, subtraction. If you know the concepts clear, you can actually balance it is very easy. I've tried my best to know. Those who have tallied the balance sheet, who have done it, they will be fine. It is very easy to tally a balance sheet. Just little bit of attention to detail will help you tally the balance sheet. Once you know how to tally, whatever number I give should tally. And make sure this all numbers when it comes, this you see, this is coming from a schedule now. So this all numbers should be same. In the closing amount should be same in the schedule as well as in the balance sheet. If these two amounts are different, your balance sheet will never tally. And that should also always see the closing amount of last year should be same as your balance sheet item amount. If there's a difference, a balance sheet will never tally. Yeah, cash and cash equivalent and bank, you can keep it different. No point of, no need to. This as of now, everything keep it as simple because you are not going deep into it. Here, your purpose is just to clear the interview and be as simple, keep things as simple as it is. Whenever you go for complex things, your manager will help you. Okay, but for that, you need to know the concepts. Back balance, if you want, you can add it. But if you add it, you need to know that, here you don't add it again then. If you club this both, this will be a closing balance then. Okay. Okay. That you need to know that once you do 4-5 balance sheets, 4-5 models, that time you will understand how things are different for different companies, how you need to tally. Okay. DCF is very easy. This is nothing. This is all what we have learned in school. Discounted cash flow. all that we have learned in school. Now just the words are changed. We think it is something, something out of the world, out of the blues. Okay, let me ask you, guys, do you know compound interest? You know the formula for compound interest? Or one second. If I ask you that something is costing you 1,000 today, this I have told you in first class also. If the inflation is 10%, what will be its price after 1 year? What will be its price after 1 year? Something is cost you 1,000 today, inflation is 10%. What will be its price? Future value after 1 year? Can I say this formula? No, this formula future value is equal to present value into 1 plus r, and then 1 plus r to the power n, right? You know this? Everyone has learned this, not now in school. Whichever stream you are from, or whichever board you are from, CBSE, ICSE, even state board people have learned this. If you are from ICS and CBSE, you must have learned one more extra. State board people have learned this. So this is quite basic. If you go and ask to your younger sibling, he will tell you this, right? The same way, if I have the future value, if I want to find the present value, what should be the formula? I have to find the present value. What will be the formula? This is future value, so I have to find the present value. Present value will be what? The future value divided by 1 plus r to the power n. Right? I hope everyone knows this. The same way, here, this is what forecasted, right? This is forecasted. 1 year down the line, I give you an inflation rate of 10%. Okay. This is the value after 1 year. Am I right? Let's say 1, 2, 3, 4, 5. This is the future value, right? Now, this is what we have forecasted, right? What that future value is equal to. Sorry, this is forecasted. 23 is after 1 year, right? So if I tell you that 343 is the value after 1 year, inflation is 10%. What will be its present value? Can you find present value? Can you find? Here, can I do this? What is the formula for present value is future value divided by 1 plus r. See what I'm doing? I am not punching any number. Future value divided by 1 plus r to the power 1. What I'm doing? Future value. This is what 331 divided by 1 plus inflation rate to the power 1. Now this was called compound interest. In school, this is called discounting, finding present value. No, you don't say present value. What you say? You say discounting cash flows. Now what is it? Discounting your cash flows. See, here I don't even need to use my calci. It's done so easily. Now I have to just copy this, next time. When I copy this, next time what happens? This also changes. But I want this to be constant. Okay, so I need to copy this right over here. Everything I need to copy. So what I do is I freeze this row and I just copy this. Fine. That's it. This is what present value of your FCFF. Now what we have told it over here is that this is the when you add all this, sum. You add all this. But this is the value of your company, 14,000 144. Discounting your cash flows means what? You assume that this is the cash that company will earn, and then you discount it at the inflation rate. Now, inflation rate will find how to calculate this. Now, this will be different for different companies, but as of now, just assume inflation rate. But this is your discounting cash flow, and then you sum. What are you saying? That 5 years you assume that company will earn this much of cash, and the value of the cash earned each year is this much. So at the end, when you do this, this is the cash that company will earn, and this is the value of the company. This value of the company is called enterprise value. Was it difficult over here? Finding discounting cash flows. You must have heard this word a lot of time. DCF, DCF, DCF. Is this difficult? See, till FCFF, it was the most difficult part. Tallying the balance sheet and finding FCFF. This is only difficult. Valuation is very easy. This is the only part which is difficult, and that many of you don't know. Even this is not taught in MBA colleges. Now I am teaching into MBA colleges. They are totally blank on this. They don't know what actually is being taught and how is a model being made. How is this number arrived? PAT and all. How is this numbers coming from? Oh, it's very difficult for companies to know this. Sorry, students to know this. But this is what is expected. FCFF, and then discounting is very easy. This is what we have learned in school. You must have also learned something about WACC. Am I right? Yeah, inflation rate, that I will come. Coming on to that. Inflation rate I've just told you to keep this thing simple. Okay. Because whenever you earn cash flows, can I say you should earn more than the inflation rate? Guys, am I right? Whenever you earn a cash, your return should be more than the inflation rate. Now, inflation rate is for us, for an individual, right? It's for individual, not for a company. And if company is taking a loan, let us say if the company is taking a loan at 10%, shouldn't the company earn more than 10%? The company has taken a loan at 10%. Don't you think that it should earn more than 10%? Right now? Now this is what, now this enterprise value that we have found, now this we have to compare it with the one in the stock market. Now let's say 14,000, this is the price of the full company, okay? Now if someone is giving this company at 10,000, then only there's a point to buy this company. If someone is giving at 15,000, obviously there's no point buying this company. Okay. This is the enterprise value. Now we'll come on to this. As of now, just remember how to calculate DCF is to select all this company. Now first, let's come on to this inflation part. Now what is that inflation? Now inflation is for normal public. This inflation is called your weighted average cost of capital. Now how many of you know this? Or have you heard this? That is called your WACC. How many of you heard this? And yes, you have heard this. You have heard it this when you heard cost of equity and cost of equity. You heard in finance, right? All those in class, okay, your MBA class or maybe your CFA or CA classes. And those who have not heard this, those who haven't heard this is not what you have hearing it in MBA or maybe in your post-graduation. This is what you have done it in your school. Again, this is what you have done it in your school. Now the things are shown us in this way that we think that, oh, this is what is a rocket science or the concept that was being taught in finance. This is all based from school. Just the words have changed. That is why you think that it is difficult. I will tell you. Let us say you are taking a loan from bank one and bank one, bank two. Okay. From bank one, you took a loan of 1 lakh. From bank two, you took a loan of 3 lakh. Okay. If I say that the interest rates, okay, is 10% and 20%. What should be my average interest rate? I have to find my average interest rate. How will I find? From bank one, I have took a loan of 1 lakh. Okay. How do I find my interest rate? Average interest rate. It's 15. Others? What is the interest rate? Everyone think it's 15? Guys, now go again back to your school. Once again, forget about weights and all, Manish. Go back to your school. Ask your younger sibling how to calculate this. You know how to calculate this? Can you calculate what is the interest expense on both? You cannot do directly, okay? 10 plus 20 divided by 2. The amount is not same. Let's go the old school method. What will the interest expense? If you take a loan of 1 lakh, interest is 10%. What should be the interest that you pay? What is the interest that you will pay? 10,000, right? It is 1 lakh and 10. So what interest will you pay on 3 lakh? 60, right? 3 lakh into this, 60,000. What is the total interest that you pay? 70,000. What is the total loan that you have? 4 lakh. You pay a total interest of 70,000 and you have a total loan of 4 lakh. So how much is the interest rate? Average interest rate? 15. Is what? 70,000 divided by 4 lakh. It's 17.5%. It is not, no, it is not 15%. Now this is what you have learned now. Just because you go into finance and think about all those things, no? All those, big words, weights and all, that is the reason you forget your basics. This you have learned in finance, in CA or in MBA, you have learned this. When have you learned this? Calculating? When have you learned this? In CA, MBA? Not even in 10th standard you have learned it. You must have learned it in 7th and 8th standard. Just because you are now big or you are now postgraduate, you think that things are very difficult in life. Everything is difficult. This was never taught in our whole career back. Just the words, they just change the word. Now, can I say this is average cost of capital? From this word, your what? Weighted average cost of capital. Weighted average cost of capital. I just remove the word weighted. What is it? This is what average cost of capital means. What? Cost of capital means cost of your. So can I change this to debt and equity? Can I change the bank from debt and equity? Now, cost of capital is what? What is capital? Who are the capital givers to you? Equity and debt. Just because that word was put weighted, you forget all your concepts what you have learned in school, right? Everything. Now I will doubt you now whether you have been to school or you have just copied and passed. Reason you make finance complicated. This is the reason, and it has been shown in this, the way it has been taught. That is the problem, that you people think that finance is difficult, or maybe this now even your father will, your parents who have gone to school, they must be knowing this. Any stream, whether you are from arts, whether you are a doctor, whether you are from science, whether you are an engineer, doesn't matter. Just I change the numbers over here. When I tell about bank, everyone knows. But just when I do debt and equity, you forget. You forget all your concepts, basic concepts. Right now, bank, I told you to everyone knows. Bank has an interest rate. What? That interest rate is called cost of capital. That's it. Cost of capital. Means what is the cost? This is, can I say this is your total capital now? Right now? This is your total capital 4 lakh. And then this is your interest cost. Cost of debt is this, cost of equity is this. Cost means what? Interest rate. This is how you calculate. Difficult, huh? Very difficult. And there's a formula to find this, right? There must be some formulas also. Those who know back, they must also know the formula for this. All those. Cost of capital. Now that weights word, why is that weights word given? Now since you are postgraduate, you are not in school. That is why that weights is used. Now what is that weights? If I ask you, out of the total capital, how much percentage is debt? How do you find? If I ask you out of this total capital, how much percentage is debt? 100,000 divided by 400,000. Right? Debt to total capital is 25%. So obviously debt is 25%. So your equity will be how much? 75. So again you can do 3 lakh by 4 lakh. What is your cost? Cost of debt is 10. Cost of equity is 20. And here you just have to multiply this. What? Debt, cost of debt with weights of debt. Just multiply this into this, and again 75 into 20. What answer you got? What answer you got? Same answer? Which is the easy step? This is easy or this is easy? Now obviously if you are a postgraduate, obviously you are expected to know this kind, because this is what mental maths. This is maths. Not mental maths. You can say what do you say that? Quick maths. No, mental maths only we say, right? Rather than doing all this, this is the school stuff. You and your sibling will get the same answer. Just because you are more, bigger than him, you need to know, you need to do it very fast, quickly. This is what he will do. But still, he will get the right answer. And since you are postgraduate, you will put all those, VAC formulas to find, all this. You must have known this is the formula for VAC. Let me show you the formula for VAC. What is the formula for VAC, which is as per Google and as per books? One second, I will share my screen. Does VAC has a formula? Right? VAC has a formula? Weights. Just because I put weights, the Rishabh has given the formula. See, this is a formula, no? You have to remember. Now go and remember the formula. Okay. I will ask you after 3 months. That time you will forget. Because sir, VAC to kuch tha humne padha tha tabhi. How to calculate average interest rate? Yes. This is what you forget. Go and ask your friend now. Okay, VAC. I have seen MBA students, saying this. Sir, MBA में पढ़ा था अभी भूल गए. Means how if you tell something like this, how stupid are you? I mean, or how what again? I don't have words to say this now. This is such a small thing that you don't know. Formula, no? This is the formula, right? Weights. You have a formula over here. You see, this is the formula. Even in books, CFA books, it is given this way. E is what? Market value of equity, market value of debt. Then what? D is equal to E plus D. Cost of equity, R is cost of equity, R is cost of debt, tax rate, etc., etc. Will you forget this? Ever in your life? In whatever field you are working? Even if you change your total field, to go from finance to, let's say, an arts field, you forget this? How to calculate VAT? Only I put the weights. That is the reason. Means only a weights word was there. That is why you all forget your all concepts, and then you say that, sir, there's a formula to calculate VAT. What 17.5% is your VAT? Now over here in the debt, now what happened? As I've told you that interest we did 1 minus t. Remember? Interest we did 1 minus t. Now what is that t? Because it helps you reduce your tax expense. Okay. So ideally, if your debt is 10%, you don't ideally pay 10,000 out, right? And I said this 10,000 expense will save tax on this. So ideally, your cash outflow won't be 10,000. How much it will be? If I say the tax rate is 30%, what will be my actual cash outflow? Yeah, 7,000, right? So you are obviously, it will not be 10%. Your rates will be 10% into 1 minus your tax rate. This is the only thing that you need to concentrate on. So whenever you talk about cost of debt shouldn't be 10%. It should always be adjusted for tax. The cost of debt, you don't say cost of debt, it should be always after tax cost of debt, because debt helps you reduce your taxes. Okay. So after tax, so you will not pay 10,000. So obviously you cannot say my debt was 10%. You will say my cost of debt was 7% only. Okay. Now again, this also, even you don't have to know this number, you have to know this number. What is debt to equity in this? Can you find debt to equity ratio in this sum? What is debt to equity ratio? No, in point. No, debt to equity, I'm finding you. Not 1:3, just number. Not the ratio, number. I'm asking you number. If I want to find what is the debt to equity ratio for this, I said debt is 1 lakh and your equity is 3. It's 0.33, not 0.66. 0.33. Debt to equity ratios. This is all ratios, okay? 0.33, right? If I give you that my debt to equity is 0.33, can you find total capital? Now in this, when I say that my debt to equity is 0.33, what does it say? Can I say my debt will be 0.33 and my equity is 1? Can I say this? Whenever I say my debt to equity is 1/3, can I say this? My debt is 0.33 and my equity is 1. Can I say this? No. What does debt to equity means? Debt to equity is 0.33 means what? My debt is 3. No. See this ratio. What does this ratio mean? So this is not debt by equity, right? Means if your debt equity is 1, your debt is what? 0.33, right? Now in this example, your equity is what? 300,000. In an example, if it's 300,000, so what will be your debt? Obviously, it will be what? 300 into this, right? Almost, because it's 3333, okay? Right, huh? Right? And this debt to equity means that only, right? If your equity is 1, your debt is 0.33. That is what this ratio means. Every time, this is also you have learned in school only, okay? Fractions or fractions. Debt to equity is 1 means what is always, debt by equity. So 1, when I say your debt is 0.33 and equity is 1, your total capital is, can I say total capital is 1.3333? Can I say this? Yeah, I'm not using numbers also over here because I know that whatever numbers I put, whether I put 3 lakh, 5 lakh or any random numbers over here, how does it matter? My debt to equity will still be same only, right? Now, can I say my total capital is 1.33 now? If my total capital is 1.33, can you find weights? Can you find weights? Fine. What will be? So your data, don't you get debt to equity data in your balance sheet? Can you find debt to equity in your balance sheet? Right now? If I give you, let us say my debt to equity was 0.5. Okay, I give you. I'm assuming my debt to equity was 0.5. Help me find the debts, weights. Tell me what will be the weights? Your calculation, tell me. If I say my debt to equity is 0.5. Fine, am I waiting? How to do it? So can I say over here my debt is 0.5. So what will be equity? Obviously debt is 0.5, so equity will be 1. So my total capital is what? This plus this, 1.5. How do you find weights? My debt is 0.5 out of point this. So this 0.333. Obviously the other will be 0.6666%. Just with one number you can find the weights, right? Do you even require this amount, debt and equity amount? This is very easy amount over here, but for companies you will not get such easy amounts. It will be some random. Let's find a company. Let's find a Tata Motors. You tell me, find the weights. Capital structure. This is called your capital structure. Tata Motors have a lot of debt. Okay. Let's go. Total borrowings. Total borrowings is 144. And your equity is, this is your equity, okay, 766 plus 544, 25,409. So your total equity is how much? 766 plus 25,409. So 26,175 is your equity. And your debt is 144,354. Can you find debt to equity? What is the ratio for debt to equity? Debt is 144,354. What is your equity? 26,175. Just take long-term debt. Okay, one second. Just take long-term debt. 94,000. 94,000. Just take now 94,154 divided by 26,175. Because long-term debt is short-term can be paid off. 3.6. 3.6 is your debt to equity. Find the weights. Find the weights. Find the weights. 3.6, take 3.6 as your, what will be the weights? Right, that will be 78. It is what, 3.6 divided by 4.6, because you know that equity will be 178. So obviously 78 is debt, so 21 will be equity. Now if I give you, this will 78 and 28, 78 will take and 22. Okay, now if I give you the cost of debt and equity, can you find the WACC? Can you find the WACC? If I give you cost and equity, cost of debt and equity, what we assumed that was 3.69, right? 3.6. The equity is 1, right? Your total capital will be this, and your weights will be 78 and 22. Okay, if I give you cost of, okay, can you find cost of debt in the balance sheet or P&L? From the financial statement, cost of debt is what? Interest expense. Can you find this? Can you find? Can you find cost of debt? If I give you a annual report, means what all things you require to find cost of debt? If I give you a balance sheet, a P&L cash annual report rather, can you find cost of debt is what? Interest expense, interest rate. Can you find interest rate for a company? Interest rate. The total borrowings you have a total borrowing, right? Over here it is, as it is they have given. Total borrowing is 144. Now where will you find interest expense? Where will you find interest expense? P&L. Right? P&L, you have an interest expense. It is what? Around 9312. 9312 is your 9312 is your interest expense, and the debt was 144354. Got into 100. 6.45%. Right? 6.45% is your cost of debt. Am I right? Right, 6.45% is your cost of debt. No, now both, now both loans, because total loan, no? Okay. This is the average usually. So you got 6.45. Now should you take directly 6.45 or should you modify this? This is obviously before tax. The tax rate in India is assumed 30%, because 30% tax on the profits. So what should be after tax cost of debt? How to find after tax cost of debt now? $6.45 into bracket 1 minus 0.3. Right, 4.5% is your after tax cost of debt. And our cost of equity will come onto this next class. I just give you 15%, okay, as of now. Can you find that? Percent. Can you find that? What to do? How to find back? Which are the weights? Which are the weights? How do you find back? This is your weight into this plus for 1, and then again this into this. So your WACC is 7%. So now we have got the WACC of Tata Motors. How many minutes it took? It is not even a 1 minute job. It's not even a 1 minute job to find. Now this cost of equity will come to on this later on, but easy to find it just from P&L and balance sheet. You know, you can find everything. Am I right? Just from P&L and balance sheet, you can find everything. Yeah, so 100% will be equity. Then the cost of capital will be cost of equity only if there's no debt. Let's do it for 0. Let's find your WACC for 0. Okay. Cost of equity assume 15%. Okay. How will you get debt to equity? Now debt to equity is usually taken as an average. Okay. How much balance sheet we have? Balance sheet we have from FY18. Okay. Can you find debt to equity? Let us find debt to equity of 0. Total debt. Now Hero doesn't have total debt, so the total debt over here. Borrowing this plus this. Total debt divided by total equity. Total equity is this. Total equity. Okay. $22. Now it's hardly, Hero hardly has a debt. So it is around 0.02. The average is around historically the average is around 0.02. Now can you find cost of, how do you find cost of debt? Now recent cost of debt, okay, not historical. Recent cost of debt. Interest expense 22. Interest expense was how much? For 53. Divide by again the total debt. You have this borrowings, sorry, 22. This plus this. Right? 15% is your cost of debt. Exact. What about tax rate? We have found tax rate. This is before tax. Huh? This is before tax. So always remember before tax. Always make an habit of writing this before tax cost of debt and after tax cost. Tax rate we have. Tax rate in our P&L we have for 22. We have found it. It was 24%. What will be after tax cost of debt? into 1 minus 0.24. It is your after tax cost of debt. Before tax cost of debt is what I told you now. Interest divided by our total borrowings. Interest you get in P&L. This is the total borrowings, total loan. The tax cost of debt. See now everything is linked. Apart from this, everything is linked. Let us also assume this. See now, this you can take historical also, or going ahead if the company says that we want to, maintain our debt to equity at 0.1. This is usually given in annual report in the capital structure that they need to increase debt or decrease debt. Can you find the weights now? Debt equity weights. Can you find? What will be it? Tell me. How much is your debt? The equity. And then total capital. We can use this to make this work very easy. Your debt is over here. 0.2. The equity will be 1. That's the assumption. Assumption is actually this plus this is your total capital. Weights. This divided by this. It's hardly 2%, and then obviously the 98% will be your equity. If I only change this number to 0.1, it changes everything. You see? WACC, weight you have. In front of you can put the cost. After tax is this. Equity is this. 15%. Debts into this debt. There's hardly any debt. And then WACC. Your total WACC is how much? 15% is your WACC. Now a change in this, if I do it 0.5, everything changes. See, with just one, this is one amount. This is target, usually a target. The target debt to equity. If target debt to equity is given, then you have to take target. If target is not given, you have to take the historical debt to equity. Now let us assume that we have taken target. Company has given an assumption that they will maintain a target of this will be your WACC. Now this WACC will be linked to your DCF over here. But what will happen to this value now? It was 10 that we have taken. Now it will become 14. So this value will increase or decrease? Your company's value will increase or decrease? Company value or increase or decrease? We had assumed 10, but from calculation we came to know that it is 14. So obviously it will decrease because what? We have divided this number, right? Now denominator has increased. This is maths. Conceptually, this was a cost of capital, right? Cost of raising the money. If your interest rate increases, it is good or bad for the company? The interest rate increases, is it good or bad? So it is bad, so obviously we will value the company at much lesser price. This is conceptual. This was maths. That denominator increases, that is why value decreases. What is conceptual? Is that because if your cost increases, obviously your value is lower because now you have to pay a higher price. 1278. This is your value. Got it back? Got it? What is WACC? Formula, no? WACC is a formula. Can even a 10th standard guy know this? You tell him, you say that finance you learned, or maybe you are not good at finance because you are from science background, you are from arts background. Some says that we have not done MBA, that is why we don't know. We are not CAs, we are not CFAs. Now you think that where are you in this competition? If you think that this all was difficult and this all things you have never learned in your life, then you were wrong on this. Now WACC, If I ask you 10 years afterwards, you forget? If I ask you 12 a.m. in the night, get up and tell me what is the formula for VAC. Do you even have to remember the formula? VAC. Just because finance, this, people have, overall, people have made this very difficult. Even accounts. Was balance sheet difficult? Now, those who have done it, if you have done it for the first time, then it was a very good thing that you have understood everything. Because first time, if you make this, and if you understand, then obviously you have paid more attention to my classes. Tallying balance sheet, it is not again accounts. It was not accounts. It was day-to-day life, how a balance sheet is created and how it is reported. It is not double entry system that matches. It is the source and the application that matches. Double entry, you are not an accounts graduate to pass entries. You are not a CA to pass entries. Finance and accounts are totally different. Balance sheet is made for every individual, whether he is a doctor, whether he is a pilot, whether he is an engineer, whether he is an bankrupt. So it is not something that balance sheet. You can also tell your parents, or at least have a record. Record keeping is what accounts. Your mom will be knowing it much better. She is the one who looks after the finance of the whole house. She might be knowing much better what is the source and where all the money she has applied. So assets, just because we tell it as asset and a liability and all, that is why even a normal person get confused. What is asset? What is liability? If you give him a very simple example, he uses in day-to-day life. Even you use your wallet day-to-day. You know what are the things you have. What is it called that you don't know? That is why you say that finance is difficult. I hope now everyone has know this DCF, enterprise value. Clear everyone? Any doubts? Any doubts? There was only one thing that you have not learned in the school. All this you have learned in school. Now, one thing which I have not learned was, okay, from 5th year, we have forecasted till year 5. Do you think that Hero MotoCorp will go bankrupt after year 6? We are forecasting FY27. What after 27? Hero will go bankrupt. They will stop his operation. Hero will still grow, right? Hero will still grow. Means the cash flows of Hero will still, we expect it to grow, right? Because we say that this is a going concern company. We don't say that the company will go bankrupt. We assume that it will grow till, you don't know how much. You cannot take 100 years and discount back. Okay. You cannot do that. You cannot take 100 years and discount it back. What you need to do is, you assume a constant growth. Constant growth. A constant growth is what? It can also be set to your GDP growth. See, because company just cannot keep on growing by 10% every year. It has to stabilize at some point in time. Am I right? 20-30%, even company cannot keep on growing, because after a few time, when the revenues are so high, it has to grow at a lower pace. Now, what is this constant growth? We assume that at least our company should grow as per the GDP growth rate of India. Agree? If the GDP is growing by 5%, should you at least expect that your company should grow 5% in the long run? Not next year, but in the long run, at least by 5%. If not, then what is the point of doing your business? India is only growing by 5% and you are growing at 2%. Does it make a sense to do business then? So we take a constant growth. So what is the GDP growth rate of India? Not last year, historical GDP growth. What is the historical GDP growth in India? I hope everyone knows what is GDP. Growth in goods and services in India. Okay. Gross domestic product. Goods and services growth. So what is GDP growth of India? Anyone? Google. What is GDP growth? Historical GDP growth of India. Yeah, 6 point. This not 6 point. Yeah, 7%. Usually India's GDP growth at around 6 to 7%. So historical last 20-25 years, India has grown around 6 to 7%. So we will take 6%. Now what we assume is that this company will grow at this future cash flows will grow at 666% every year. 666% every year. Till when? Till infinity. You don't know. So you cannot, track this and find the present value for each of the years. You have to find a terminal value. To find a terminal value means what? Value of the cash flows. Value of the cash flows from year 6. What will be the value of the cash that company will earn all this years? When you invest in a fixed deposit, you invested 1 lakh, okay, for 3 years, and interest rate was 10%, and inflation was also 10%. Okay, can you tell me the cash flows that you will earn 1, 2, and 3 years? How much cash you will earn in the first year? Interest rate is 10%. You have invested. FD, everyone knows, no? Fixed deposit. I'm saying that fixed deposit gives 10% interest. So what is the money that you will get in, tell me, 1, 2, and 3 years? What is the money that you will receive? One lakh into 10%. Next year, second year, how much you will receive in second year? 11. No, don't compound it. Don't compound it. This is what you receive in your bank. Next year, no, don't compound it. Don't compound it. Normal, simple interest. 10K. Next year also 10K. Each year 10K. And what is the third year? How much cash you get in the third year? How much cash you get in the third year? And I said 10,000 you get, and the 1 lakh that you have invested, you also get that. How 1 lakh 30? Third year. First year you got 10, second year you got 10. Third year obviously 10 plus the 1 lakh, right? Not 130. The principal amount and the interest. Now this is what you assume. Now this is what you get. Can you find its present value? Can you help me find its present value? How to find present value? Now 10,000 you get after 1 year and the inflation rate is 10%. What will be its present value? What will be its present value? How do you find? The same way, 10,000 divided by 1 plus 10% to the power 1. Finding present value. What I will do, I will freeze this number. When I do this, and if I sum this, what value I will get? What value I will get? If I sum this, so can I say this is the value of my cash that I will earn after 1 year? So 10,000 earning after 1 year, its value today will be 9,000. 10,000 earning 2 years down the line will be 8,000 value in today's sense, and getting 1,10,000 after 3 years, its value today will be 82,645. So when I sum this, what I get is 100,000 again. I get this 100,000. What is this? Since your interest is equal to your inflation, tell me guys, did actually you made money? Actually your amount increased? Actual buying power increased? Can I say that you earn 10,000 extra so you can spend more 10,000? If inflation is 10%, if you are earning 10% only interest, means today a milk is costing you 10 rupees, it will cost you 11 rupees tomorrow. Though you are earning 10,000 extra, rupees 10% extra, you are spending it on your products only, the same products. So did actually you made money? Did actually you make money? Did your buying power increase? If your salary increases by 10% and your expenses, your inflation also increases by 10%, does that 10% salary hike is of any good to you? Can you say you had a salary hike of 10%? Was that of any use to you? Your expenses also increased by 10%. So in your bank account at the end, there will be same amount which has been saved. So this, if I do it same for 5 years, then will my value increase? If I put rather than 3 years, I put it for 5 years. Will my value increase? If I put this FD for 100 years, will my value increase? Present value will increase. This will be same throughout. Now, this present value, see if I do it for 100 years, now I will get the same amount. No, if I do it, let us say, I tell you, okay, I do it for 5 years. This 3, 4, and 5. Okay, I will get the same amount. When I put for 5 years now, I will get the same amount. See, I will get the same amount because my value is never increasing. Now this, I don't have to calculate. Now if I want to calculate the present value, now this one, this 100. How will I do this? Present value of what can I say? This is the present value of all the cash flows that I will earn. 1 lakh is the present value of all the cash flows that I will earn from here till 100. Even if I take it till 100, I will get the same value. And finding this value, every time you don't need to do this. You don't need to calculate the present value of each of the cash flows. You know now that this is the cash flow that is constant you will get. 10,000 is the constant cash flow you will get. So what I do is 10,000 divided by, now I don't do 1 plus because here we don't have the n, but this is still infinity. We don't have the n, that is number of years. So what we do is we just take the inflation rate and you get the value. Got it? What I do is, now I will not take 1 plus r. For what? For till infinity, okay? Because I don't know the years, till how many years I am calculating. 1 plus r to the power n, we don't have n over here. So what we do is we directly take the 10%. Okay? Over here, if I tell my cash flow is increased from by 6%, 417 starts increasing by 6%. Now I say that it is constant. 4977 is constant. Okay. I will receive 4977 for the rest of the year. How to find the present value? How will I find the present value now? What should I do? This is a constant amount. Here also 10,000 was constant. What I did? 10,000 divided by the inflation. That is your back. Here also, what will I do is 499 divided by what? What should I divide by? Ideally, it should be 14. If I say that it is constant, it should be divided by 14. But now since growth minus inflation minus growth rate, the other way around. What is that? Now since I am saying that this is constant, okay, so this should be my terminal value, okay, but this should be my terminal value, okay. But now what I say that this should, because it will grow, right? What I'm saying that it will grow at a constant rate. So tomorrow, next year, it will become, 499 will become this 52. Every year it will keep on increasing. So if your cash flow is increasing, what should be your terminal value? I mean, should it increase or decrease? In this example, if 10,000 keeps on increasing, what should happen to my present value? Increase or decrease? My present value should increase or decrease? It should increase because now you are discounting a much higher cash flows. It is not constant. So this should increase. So what is that? You subtract it by the growth rate and make sure you put on brackets over here. Now this is called your terminal value. What is it? This is called your terminal value. Now what is the formula for this? A terminal value is to be found at the end that you have forecasted. This is the 27 you stop forecasting, 1, 2, 3, 4, 5 years. You have to find the terminal value over here. Now, the formula for terminal value is what? I'll show you. It is what your FCFF in the year 5th, right? Whatever the year you are taking, okay? If you are focusing for 3 years, then it will be for FCFF 3 years. Means the FCFF, okay, this one. This FCFF 5th year, 1, 2, 3, 4, 5th year. FCFF in year 5 into 1 plus growth rate, okay? That is your constant growth rate divided by WACC minus G. This is your terminal value. This is what you need to know. FCFF, the terminal value. This is the only thing that was not there in our school. Just write this somewhere. 5, whatever your focus. If you focus for 3, then 3 years, okay? What is it? What was the formula again? FCFF into 1 plus G, that is your constant growth rate, okay, divide by 14 minus again the 6. Now WACC can never be less, huh? It will never be less. If it's less, it can never be, practically it can never be less. See now, this will be now, if it's less, what does it mean? That you are getting loan at 2% and you are earning 5%. It can never be like that. This is what your WACC is, your cost of capital. Means you are getting, let us say, loan at 4% and you are investing in stock market and you are getting 10%. So yeah, everyone will make money then if this kind of thing happens. Right now? Everyone will take the same thing then. Take a loan at 2% and interest and get a return of 5%. That will never happen, okay? Growth can never be more than your WACC. Growth can never be more than your WACC. This is your terminal value. Now, total cash flows. What is the total cash flows? It is this plus 0 over here. It is only in the last year that it increases. So this is your total cash flows. Is what 34, and in the last year how much you will earn? 68.6666. So in this, you don't have to take this. You have to take this as the total present value of all the cash flows. This you find the total value of all the cash flows, and then you get your enterprise value. Okay. This you get your enterprise value. This is your terminal value. This is your enterprise value, and this is your growth, your capex. And just format this, so that it looks. So how you format this? Okay. CFF, then terminal value, total cash flows, and then this is your discount, and this is your years. And then you find your enterprise value. This is the value of your company. This is important. This terminal value, just remember, this is was the important. Just write this formula somewhere in your book or just keep it where required. It's very easy formula, but you need to know. I've given you the concept. Now concept is a little bit tricky, but here you have to remember this. Just write it somewhere where you can easily access it in your phone or somewhere, and just take a screenshot of this. Okay. This is your enterprise value. This is how you find it. This is where your cash flow, discounted cash flow ends. Now that cost of equity and the equity value we'll do in the next class. That is on probably next Saturday. Till then, you practice. See whether you get this answer. Now you can just change the answers by WACC. Since I have taken WACC as 0.4, you can just change. What if I change my debt to equity? What will happen to my value? Tell me. A question, okay. 46 to 46 is the value. Okay, I will just keep it over here. What if I change my debt to equity? I increase. 0.5 becomes 0.6. What will happen to the value? Think. If my debt increases, what will happen to my value? Reduce. Why? Why it will reduce? Why increase? When you say increase or decrease, just let me know why increase or why reduce. If I increase my debt to equity was 0.5, right? I will increase to 0.7, 0.6. What will happen? Value will increase or decrease. Because WACC will increase, value will actually increase. Cost of debt is cheaper because that is the entire cost of the company. Okay. You know, Harita told right over here, you know, the cost of debt, no, cost of debt will not increase. See, why will cost of debt increase, Rishabh? Because cost of debt will be same now. I have said that debt increase. Why will the interest rate increase? You know, here in our WACC, you know, debt, what is the cost of debt was 11.4%, and what is the cost of equity? So which is the, you know, cheapest one over here? I said debt is the cheaper one. If I take more of debt, which is a cheaper loan, what will happen to my WACC? Will it increase or decrease? See, debt will increase, right? Means the weights will increase. Now I am saying that I am taking more loans at a lower rate. Obviously, this will also change now. 67 now. This will, let's say, it becomes 40 and 60. So I am taking more debt at a cheaper rate, whereas equity is now lower. Means the one which is at the highest cost, I am taking lower of this. So what will happen to my WACC? If I take more of a loan which is at cheap cost, what will happen to my overall cost of capital? WACC will decrease, no? Because you are taking a cheaper loan. So now WACC will come down, right, guys? WACC will come down because now you are taking a loan that is cheaper than the loan that which was expensive. Let's change, okay? Let's change to 0.9. See what happens? WACC decreases. Why? Because now you are taking a debt which is much cheaper, and your equity, the expensive loan, is now lower part of your proportion. Lower debt, inexpensive debt, a cheaper debt is a higher part uh, of your total capital. Your WACC decrease. Obviously, when your WACC decrease, your enterprise value will increase. Value of the company will increase. Okay. This is, you know, after solving the model, be prepared to get this kind of questions by the interviewer. What happens when debt to equity changes? Okay, what happens now? This is a common question asked. What happens when the tax rate changes, increases? What happens when the tax rate increases? What happens when the tax rate increases? You know, when the tax rate increases, what will happen to the cost of debt? Increase or decrease? To tell me. Just tell me this answer. What will happen to the cost of debt? Will it increase or will it decrease? Cost of debt will decrease because we do know 1 minus tax rate, right? Now means now you will get a much more benefit of taxes. So obviously your cost of debt will decrease. The cost of debt will increase. Obviously your WACC will decrease. WACC will decrease. Then what happened to the valuation? The value of the company will increase. See, you can do this. Let's put this 0.5. Now let us change our tax rate. Was 24. Let us take 30. Increased? Increased because your cost of debt actually decreased. You know why? Because now you get a much higher tax rate, higher benefit. The more loans you take, the more benefit you get because tax helps you save your cash flows. Okay, I'm sharing this file. Okay, you try doing this. Try doing this DCF. See, till here it was all same. Okay, just this part terminal value was what we learned new. Rest all we have learned in school. All the things we have learned in school. This is how you just forecast it or just put it into model. One change, everything else changes. This is what modeling is. Only this part was difficult one or newer, not difficult, newer one, which you have not learned. The terminal value. Rest all the things what we have learned. What you have to do is take the cash flows and then just discount it. Now over here, just remember the last cash flows will be the terminal value will also be included in this cash flows. So try doing this. No, we will meet next time, next Saturday. That way we'll talk about cost of equity and other methods of valuation. Yeah, I'm sharing this file. I think Soumitra is not available today. So once again, I'll share you this file over here and just download it before leaving the class. Yeah, send. Okay. So I'm there for a few minutes. Can download this. Okay. And then I will leave the meeting. Okay. So thank you guys. Have a nice weekend. Meet you next time. Till then, do this small. If you want, you can do it for some other companies as well. Make sure now you're doing for Hero. So make sure do it for Bajaj Auto, TVS, or maybe some auto companies. Then I have shared in the chat box. See the chat box. Got it, guys? No? There in the chat box. Sharing it again once. Okay, fine. I will WhatsApp. Okay, fine. I will WhatsApp. Okay, fine. There in the chat box, see whether you get it. I will share it to. Okay, guys. See you. See you next Saturday. Bye bye. Till then, take care.